Did you know that in just one night, gold prices surged over $37, breaking past the $4,194 per ounce mark, signaling the start of a new uptrend that could push gold to $5,000? As the Fed unexpectedly moves closer to cutting interest rates, the USD weakens, and China quietly accumulates 10 times the officially reported amount of gold, the world is witnessing a massive flow of money leaving bonds to pour into gold. What is really happening behind this wild price surge? On Friday night, November 28th, the global gold market suddenly exploded, rising more than $37 in just a few hours, pushing gold past the critical $4,194 per ounce threshold. Remarkably, this surge was not a typical technical rebound, but a strong signal confirming that gold has entered a new uptrend. On trading floors, selling pressure nearly vanished, as if everyone hurriedly exited short positions to avoid being swept out as prices climbed. In contrast, buyers appeared extremely confident, dominating the market and driving sentiment to euphoric levels. This activity indicates large capital returning to gold, signaling a stronger growth phase ahead. Last week, financial markets were almost shaken as the probability of a Fed rate cut in December surged from 50% to 85%, according to FedWatch. This dramatic change stems from a noticeable weakening of the U.S. economy after the government shutdown, forcing the Fed to adopt a more accommodative stance to support growth. As investors saw rising chances of rate cuts, money quickly shifted. They pulled out of bonds, reduced USD holdings, and turned to gold, considered the safest haven in uncertain times. This easing expectation is creating strong momentum, driving gold prices higher and opening a breakout phase for the precious metal market. The USD index, DXY, has slightly recovered but remains at multi-month lows, showing very weak demand for the greenback. Meanwhile, the yield on 10-year U.S. Treasury bonds continues to fall, reflecting cautious investor sentiment. With a weaker USD and declining yields, gold immediately becomes an attractive destination due to its competitive advantage. The combination of these two factors is generating strong upward momentum, helping gold maintain a steady rise. Gold prices are driven not by a single factor, but by a confluence of strong macroeconomic forces. Geopolitical tensions are escalating globally, pushing investors towards safe haven assets. Additionally, global public debt is at record highs, combined with the risks of economic sanctions and the fragmentation of major economies, further boosting defensive demand. Importantly, central banks worldwide are quietly buying gold at unprecedented rates, creating a sustainable institutional demand. Altogether, these factors are forming a long-term gold uptrend, a rise supported by the very foundations of the global financial system. Technically, gold is entering a clear long-term growth cycle. Prices have risen continuously for 4 months, creating a prolonged positive trend rather than short-lived spikes. Each pullback is shallower than the previous one, forming higher lows, a solid indicator of a sustainable uptrend. This shows that gold has shifted from reacting to short-term news to genuinely leading the trend, with stable buying and increasingly positive investor sentiment. With this market structure, gold is highly likely to continue rising in the coming months, offering long-term investors an opportunity to benefit from strong gains. Upcoming U.S. economic data, including personal spending and production, are forecasted to be weaker than expected. This increases the likelihood of Fed rate cuts, putting downward pressure on the USD and bond yields. In this context, gold becomes even more attractive as a safe haven asset in a easy-to-rise, hard-to-fall state. Favorable macro conditions combined with positive market sentiment enhance gold's potential for further breakout, reinforcing the uptrend and attracting global capital inflows.
According to SOCGEN and Alpace reports, China is actually buying 10 times the officially reported gold amount, around 250 tons per year, instead of only 25 tons as previously disclosed. Its actual gold reserves may have exceeded 5,000 tons, making China the world's second largest holder after the US. China's gold accumulation occurs quietly, mainly via UK channels, to avoid market shocks. Such large-scale accumulation not only strengthens national financial reserves, but also reflects China's long-term strategy to reduce USD dependence and prepare for global economic and geopolitical risks. As soon as the market closed for Halloween, China initiated a massive gold purchasing operation, triggering astonishing gains. This move not only fuels the price increase, but also suggests a bigger strategy at work. Gold is becoming the key tool for countries to build strategic reserves in a power-playing scenario. China is accelerating gold purchases for several strategic reasons. A main factor is the fear of international sanctions, particularly observing Russia's frozen assets, prompting Beijing to be more cautious with foreign reserves and national assets. Additionally, China is implementing a soft de-dollarization strategy, reducing reliance on USD in international trade and reserves to safeguard the economy against global currency fluctuations. Gold, as a tangible asset, becomes a safe shield, protecting national reserves and ensuring long-term financial stability. Thus, gold accumulation is not just an investment, but also a strategy to hedge economic and geopolitical risks. The gold buying trend extends beyond China, spreading to many countries. India, Poland, Turkey, and Kazakhstan are actively increasing gold reserves to strengthen their economies and hedge risks. Notably, Russia uses gold for defense-related transactions, highlighting gold's practical and strategic importance. Gold is regaining its status as real money, independent of banks and paper currency, serving as a value-preserving asset amid global economic uncertainties. Thanks to this role, countries now view gold as a strategic risk hedge, protecting reserves while maintaining safe liquidity in international transactions. Buyer behavior is changing to adapt to volatile markets. Instead of large investments, many small investors buy 1 or 0.5 taels of gold for easier liquidity and flexibility. Some choose jewelry to preserve value and avoid large price gaps between bullion and market gold. Experienced investors adopt a buy-on-minor dip strategy, using short-term corrections to accumulate gradually. The combination of small-scale purchases and dip buying maintains continuous demand and supports the uptrend. Market sentiment strongly favors buyers, making gold hard to drop sharply. Forecasts indicate that global gold could continue rising if upcoming US data is weak. In this scenario, prices may reach $4,300 to $4,500 an ounce, reflecting extremely bullish market sentiment. The market is currently in a momentum rally, where investors mainly buy following the trend, creating continuous upward pressure. With dominant buying sentiment and weak selling, gold is unlikely to reverse sharply, making the uptrend more sustainable in the short term. International experts and organizations, including Société Générale, predict that gold could surpass $5,000 in the current uptrend. The main driver is China's massive demand, considered the key engine fueling long-term gains. China's gold accumulation not only impacts the domestic market, but also strongly affects the global market, providing sustainable momentum for gold prices. China's buying power makes gold a safe haven asset unlikely to reverse quickly.